Perhaps even more than the increase in interest rates, which of course is significant. It's a 0.5 percentage point increase. That's the largest since the bank became independent in the late 90s. It's the largest in more than 30 years, and it's going to whack 650 quid onto the annual repayments of anyone with a average size tracker mortgage. That's pretty significant, but perhaps even more than that action by the bank is the context you've just mentioned there. This is a bleak forecast for business, for consumers, for households, and for anyone wants to lead the country in the coming months. Talking about 5 quarters of recession beginning in the fourth quarter of this year. So that's throughout 2023 the economy will be in recession, and even while it comes out in the first quarter of 2024, the net effect of that, which will be the bank believes the economy will shrink both in 2023 and in 2024. So that's 2 annual consecutive years of contraction. We haven't seen that since the 1960s. And the scary number in this is the inflation figure you've just mentioned. The bank believes that inflation will peak at 13.3% this October. That is broadly in line with the introduction of the new energy price cap that Ofgem will give us at the end of August. It will be introduced in October. The bank says it believes that figure will be £3,500 per household. That's an average typical usage figure. It's not the highest it could be. It could be even higher than that, but that's 3 times larger than the figure a year ago. There is a glimmer of light around the price cap. Ofgem is going to review the figure again, it said this morning, in January, and there are independent forecasts that say the figure will be even higher than £3,500, but the bank does believe that won't necessarily see the inflationary curve continue to increase. It believes that falling commodity prices and some other cost pressures may already have peaked, so that will knock the froth off the top of inflation, but only marginally, down to a little over 12% at the start of next year. It won't be back into single digits, the bank believes, inflation, until the third quarter of next year, so above 10% for the next 9 months. I think it'll have fallen back to around 5% by the end of the year. But for anyone who is looking at this storm of impact on their personal finances, let alone businesses trying to navigate a way through, we are looking at a picture of a contracting economy, huge inflation, and little sign of anything to offset that and bring down the pressure on the economy for at least a year, because the driving force of all this, more than 50% of the impact on inflation, is energy prices. Wholesale energy prices are driving this, and they are largely external, international impacts that the bank can do very little about. It's rising, the increase in interest rates today is an attempt to try and prevent that becoming embedded through things like an increasing wage spiral. I think wages will go up around 6% this year, but the labour market is expected to remain tight. When it does, the impact of the contraction and interest rates begin to hit next year, they do say employment could rise to around 5.5%. That's nearly 2% more at the moment. So the one glimmer for those, certainly in the job market, is there is some choice at the moment, but that may change too. This is a really chastening readout from the Bank of England that will make everybody sit up and take notice.
Well, it is bleak to say the least. An economist's worst nightmare is stagflation, which is potentially something that we're facing here in the UK. And, of course, all this will make a very interesting Sky News debate a little later on, because we know, of course, that the economy has played centre stage, hasn't it, in the battle between Liz Truss and Rishi Sunak. And we're also just hearing, Paul, that the Bank of England Monetary Policy Committee of 9 members, they voted 8-1 in favour of this rise to 1.75%. So pretty much a unanimous vote from all those MPC members for a 50 basis point rate hike. And of course, we're going to be hearing from Andrew Bailey as well, the governor, this hour. What are you expecting him to say in terms of the outlook for the UK economy?
Well, I'll be interested to see the governor put it into some kind of context. We might also get a little bit of preempting positioning from the bank as to what may be quite a lot of blame, one wonders, that might be coming. The fingers might be pointed at the bank for allowing, in the views of some of its critics, some of those in and around the leadership debate in election in the Conservative Party, that the bank has acted too slowly. It didn't act quickly enough last year to try and tamp down inflation, and now what's happening is too little too late. The bank has announced that it will begin in monetary tightening, gilt sales later this year. Technical stuff, but essentially means removing some of the flow of money in the economy that some Liz Truss's team particularly have suggested has been a driver of inflation. But we'd expect to see him set out how he believed. I'm interested to hear him set out how, given the huge external shock to the economy that the increase in energy prices has brought, how this rate rise will address domestic inflation and how it will attempt to, it won't slow down the economy even more. I suppose one of the questions one might have asked him before seeing the forecast was, are you concerned that a big rate rise now relatively will tip the economy into recession? Well, he's given us the answer in these forecasts, which is that the economy is now already heading for a recession in the last quarter of this year, so that perhaps is not a factor. But it'd be interesting to hear how he addresses the impact on individuals. We have people facing this huge rise in energy prices, a tripling, something that's going to push, on some forecasts, half of the population into energy poverty if we define it as spending more than 10% of your income on energy bills. This is going to become a mainstream challenge for the affluent, not just the poor. And now on top of it, those who have got tracking mortgages that match and follow the bank base rate set here in Threadneedle Street, are facing, through no fault of their own, overnight a rise of north of £100 a month. That's another increase in the cost of living, and that won't affect everyone. Plenty of people are on fixed rates, but those fixed rates are going to start coming up in the next year or two, and the market expectation, the bank won't pin its colours to that mast, the market expectation is that interest rates will get above 3% over the course of the next couple of years before stabilising. So hearing how a man who's responsible for the big macro picture and steering the economy from this building behind me, how he addresses the challenge to individuals, which has just got a little bit harder because what the bank has done, but the rationale generally behind raising interest rates to try and tamp down rising inflation is that if it's not hurting, it isn't working. But it is, by many people's reckoning, this may be the first time the bank has ever increased, certainly in the period of independence since 1997, it's ever increased interest rates during a recession. Many of the assumptions about how the economy works and is managed have been turned on their head by this session of shocks, from Brexit through COVID and the disruption which was continuing before the war began in Ukraine. And they're dealing with the aftermath behind me, and we'll all be dealing with the aftermath in our personal budgets for a very long time to come.